Ladies and gentlemen, welcome to our investing podcast. Our guest on the podcast today is Nick Maggiuli, the creator of the famous personal finance blog of Dollars and Data since 2017, and also the chief operating officer for Ritholtz Wealth Management. He has also recently written a book, Just Keep Buying: Proven Methods to Save Money and Build Wealth. During his career, he also worked in litigation consulting, but after that, he suddenly discovered his passion for personal finance and investing and has started to publish one blog post a week, moving to New York in April 2018. Without further ado, let's welcome the one and only Nick Maggiuli.
Thank you for that great intro, Victor. Appreciate it.
I'm really glad that we have the chance eventually to discuss, and I would like to begin by asking you, how have you discovered your passion for finance and investing while pursuing a career in law?
So the career was in litigation consulting, which is kind of related, but I was really doing like a lot of data work there. And so basically the lawyers were our clients. I wasn't a lawyer, but I was working for lawyers, and they would have us run all these data analysis, things like that. And so I got very good at doing data work, right? And so that's what I really love doing as well. And I said, you know what? I love personal finance and investing. I love doing data work. I haven't found too many people that dig into the data like in a really, really deep way. Like they do have charts and stuff like that, and they can do certain things, but I feel like there's a lot more that could be explored here. And so that was kind of my, reason to get into the industry, because I love data, I love statistics, things like that. And I was like, hey, how can I apply that thinking into personal finance in a way that hasn't been done before? And so that's what I've been trying to do for the last, 6 or so years now.
Sounds really, really great. For those of us who are, let's say, new to investing and feel overwhelmed by these challenging times, how do you believe we should think about risk and reward, and what should we expect from financial markets?
I mean, you have to expect these kind of things and that they will happen. I mean, I like to just think of, they say history doesn't repeat, but it rhymes. And recently I was in Italy with my sister, just like on a family trip. And while I was in Florence, I discovered that they had these like little windows, like these little tiny windows about the size, like you maybe fit a small wine bottle through or a small glass of wine or something. I was like, what are these things? And I actually found out they're called wine windows. And they were built during like the 1300s or 1400s, whenever the Black Plague was happening. And the shopkeepers used to, sell things and sell wine and things through these little tiny windows because they didn't want to come face to face with someone, get the plague, right? And in Italy, in certain parts of Italy, like 2/3 of the people died from the plague, even though it only killed, I think, 1/4 of Europe or something, maybe a little bit more than that. It killed literally 2/3 of certain parts of Italy, right? So they were very afraid of the plague. So they built these little wine windows to sell things. It's so funny. Remember, that was back in the 1400s or whatever. And they started reusing those during COVID. The same little windows that they stopped using them basically, because why would we need them anymore after the Black Plague happened, right? But during COVID, they started reusing them again. And so it goes to show that there's like these cycles of history, and not like a cycle in that way, like, technology moves forward, things move forward, but there's just repetitions of things that is just it's too uncanny. And I see the same thing in financial markets. The market's down 20%, then it's up, and then it's down, it's all over the place. And you should expect that type of stuff, expect volatility, expect in a lifetime to be cut in half at least 3 times, 50% drawdowns in aggregate markets. And I think we will see that. Just in my lifetime, I've basically kind of seen 2. I've seen .com bubble. I was only like 11 years old at the time, but I saw the .com bubble. And then I saw, '08, right? Those are the 2 big 50% drawdowns. And I almost guarantee I'll see at least 2 more in my lifetime, at least 2 more, if not more than that, right? And so that's just a natural occurrence. Greed and fear, these cycles play on themselves.
Given the lack of useful information in some countries like Romania, for instance, as well as the multitude of fake financial gurus, how can people find good information and ignore bad information, since it's easier to follow those who promise you very high returns without mentioning anything about risks?
Yeah, I think the key is to find people you admire and figure out why you admire them first. Because you can't be like, oh, they're rich, therefore I admire them, because they could be rich from a host of other things, right? Someone could have had an inheritance and said, oh, hey, I did this all in real estate investing or trading or whatever, and you don't really know how they got their money, right? So I would say find those people you would admire intellectually, not just from what money they have. Like who do thinking do you admire? Think through a lot of these things and try and follow people who you trust and see who they follow and who they kind of look up to, right? And so it takes time. You have to learn like, hey, this isn't really right. The data shows that most people can't beat the market. Most day traders don't make money. Doesn't mean that there aren't some out there. And the thing about those like trading courses and things like that and some of those gurus is like some of those people actually are very good. The problem is they may not be able to know why they're good. Just because I'm good at something doesn't mean I'm good at training someone to be good at something, right? And I think that's the difference between a coach and a player. Like sometimes there's star players and they can try and explain what they think they're doing, but they actually can't see it because they just have it so ingrained, right? It's like they know so well that they can't even explain what they're doing. And so a lot of times it takes other people, coaches, people who can actually analyze and say, hey, that's actually not right. This is why you're good, right? And so it's really tough to know. So just keep that in mind with any single person. I would say the same thing.
You have recently written a book, Just Keep Buying, Proven Methods to Save Money and Build Wealth, which describes your core investing philosophy. Could you perhaps tell us why dollar cost averaging beats buying the dip?
Yes. So I think this whole idea of buy the dip, and when we say buy the dip, most of the time, what I think we mean is people are holding cash on the sidelines. They're waiting for a crash and then they're buying the dip. Now, can that be profitable? In some rare circumstances, yes. The problem with this philosophy is that most of the time, the dip never happens, or if the dip happens, it dips to a price that's much higher than what you could have been buying at previously. So basically, big dips are rare. That's the punchline. Because big dips are rare, buying the dip isn't that profitable over the long run, right? If you get lucky and you happen to have a bunch of cash right when there's a dip and you buy it and then it recovers, you've done incredibly well. Anyone who did that in March 2020 should, if they bought then, is doing very well right now, even with our current crash, right? So that's one thing to keep in mind, but like it's not a long-term profitable, strategy. At least historically, it wouldn't have been because dips are rare and big dips are rare. So that's what you have to keep in mind.
You have mentioned that you are not a supporter of buy the dip for the US equities markets, at least, because you keep cash for too long, and even when the dip comes, the price might still be higher than if you have invested all of it right away. What about buying the dip in several other markets? Because, there's always an opportunity somewhere for contrarian investors, like, for instance, Chinese or Vietnamese equities most recently.
Yeah, so I haven't analyzed the data in every single one of these markets, so I can't rule it out. But I think the premise of investing almost negates the idea of buying the dip. And what do I mean by that? The reason you buy something is because you expect it's going to go up over time, right? So let's just assume we could get rid of volatility and we just got the average return every day. No volatility. Of course, this is a crazy thought experiment. But if that was true, you would just have a line that just increases very, very slowly over a very long period of time. So it would always be advantageous in that world to buy sooner, right? So in any market where that line isn't going up over time and maybe it's going down, then yes, buying the dip would be profitable in some sense, but you would actually relatively it's not, because you're buying the dip in something that's going down over time. So you see, it's like the premise of the question, it just doesn't even make sense to me. Nothing you did wrong, but people ask me this question all the time, but it's like, why would it be profitable to buy the dip in certain times when we know that we want this thing to keep going up? And if you expect it to go up, why would you be waiting, right? It's a weird thing. So that's kind of my take on that,
Yeah, and we also have to think about idiosyncratic risks, like it happened in Russia, I think last or this year. Also, volatility might play a role. So you have to also compare Sharpe ratios for those investments, so not only absolute returns. And if you buy the dip in individual markets, I suppose you also have to start trimming your position at some point. So position sizing also important. So not easy to do for, I think, retail investor.
Yeah, and I think when you say buy the dip doesn't always work. Look at what happened in Russia. Russia went down 80% in a month, right? And that's obviously because of actions that the government took in Ukraine, et cetera. We don't need to get into all that, but you get the point. These types of things happen, and I don't expect them to happen often, but they will happen in markets. This is why I say you have to be diversified. That's why the mantra of just keep buying is the continual purchase of a diverse set of income producing assets.
You usually mention that lump sum investing beats dollar cost averaging, which also beats buying the dip. However, if you, let's say, have a 100,000 euros lump sum to invest today, and you have no future cash flows, so no capital, no human capital for the next decade, how would you decide to invest? Would you invest that chunk in one chunk, let's say, or you would prefer to dollar cost averaging to alleviate at least some part of sequence of return risk?
Yeah, so in that, there's a couple questions there. So when you say dollar cost averaging, there's different ways of quote dollar cost averaging. What I'm talking about and just keep buying is like you're investing as you get paid, right? So it's not like you have, in this case, you have 100,000 units of currency, right? It's not you have 100,000 and you slowly wade into the market or average in, as I call it in the book. That's also referred to as dollar cost averaging, but that's different, right? Because if you're just buying over time as you get paid, you're technically doing like miniature lump sums all the time. You're always lump sum investing, really, but you don't have a lump sum. You have a very, very small lump sum, so to speak. So, but to answer your question, if you gave me $100,000, dollars or whatever currency you want, it's irrelevant. And I did, and I knew I wasn't going to work anymore. I think what I would do, I would invest it now, but I would go much lower risk. And I think that's the difference, right? When I tell people just jump in now, they get worried, and I think they get worried because of risk, right? So you would have to say, hey, I'm going to take a portfolio that's lower risk. And what does that mean? If you normally would have an 80% stock, like global stock, 20%, like let's say in my case, US bond, you can have other bonds. I just use US bonds because I believe they're the safest. So if we did like an 80-20 portfolio normally, maybe you would do a 70-30, lump sum. Maybe you would do a 60-40. I don't know. And don't get me wrong, bonds have done not great this year because rates were so low and now they're so high, but now bonds are actually paying. So right now, I think the forward returns on a 60-40 are better than where they were, even 10, 11 months ago. So because rates have gone up. So that kind of shows. So in that case, I would say don't worry about buying now. And if you are worried, it's probably the risk of your portfolio. So de-risk a little and buy now. And if you have to, you can ratchet the risk up later, right? There's ways you can slowly kind of wade back into that. There's different ways of doing it, though.
Moving now to the personal finance aspect, I would like to ask you, how do you think people should start to organize and manage their finances to overcome the scarcity of resources and avoid in the same time to become obsessed by not spending money, like being too frugal?
Yes, I think a lot of this is psychological for a lot of people. And so I've looked at some data on this type of stuff, but it's not great in understanding all this. I think the main thing you need to do is, obviously, if you're deep in debt and you're like really, really in the negative, you need to be frugal. You need to think about that stuff. But once you start building a little bit of a nest egg, then I think you can kind of, relax a little bit more and focus on growing the income and doing it. I think everyone should be focused on growing their income if they want to get better financially. I know that's easy to say, very difficult to do, but it's going to take maybe years to do it. And the example I give is, I started a blog and I was writing 10 hours a week, didn't get paid for 3 years. I'm not saying you need to take that long. That's actually kind of crazy. I think, if I had a part-time job, let's say 10 hours a week times, 50 weeks a year, that's 500 hours times 3 years, even getting paid like $10 an hour. That's, that would have been $15,000, right? And extra money I could have had, right? If I had just been doing that, right? Consistently getting paid $10 an hour even, right? So I wasn't getting paid anything, but I'm just saying, like, if you find that there's ways, that's $15,000 you can use to move out of, get out of debt or whatever, right? So find something, ways to grow your income in the long run. That's the eventual goal. But in the meantime, like, it really depends on your situation. If you're like deeply in debt, you kind of have to be frugal because there's just not a lot of wiggle room. And it's unfortunate, but if you're in that situation, it's what you have to do. But once you start digging out of that, I think the key is to focus less on the spending and focus more on your income. And what are you doing with your time to grow that?
Given your expertise in wealth management consulting, which do you consider being the best ways to increase your long-term wealth as an investor?
The best ways is just a long-term accumulation approach and a diverse set of income-producing assets, right? It's the mantra, as I've said before. And what does that mean, income-producing assets? That means assets that have some sort of cash flow. And the reason for that, it's not that I'm against non-income-producing assets. And let me just talk about each one. Income-producing assets are things like stocks, bonds, real estate, farmland, royalties, your own products, small businesses, things like that. Now, small businesses aren't necessarily income producing initially, but they can be. So that's all the income producing stuff. And there are others, right? And then there's the non-income producing. That's stuff like gold, art, wine, Bitcoin, investing in those types of things. And I think 90%, 85 to 90% of your assets should be in income producing in the stocks, bonds, real estate, farmland stuff. And if you want, up to 10%, 10 to 15% can be in the non-income producing. And the reason I say that is because income producing assets have some sort of cash flow that you can anchor a valuation of an asset, right? But non-income producing assets don't have that. Like, what is the thing that makes gold have some value. You could say, oh, well, it's because we use it in certain applications in dentistry and a couple other ways in, electrical, some electrical parts use gold and stuff like that. But like, is that the only way to value? What about wine? Like, how do we value wine, right? It's like a lot of these things are just based on what other people are willing to pay for them, right? So there is no theoretical floor besides $0, right? However, with income producing assets, at least in theory, like there's a cash flow that I can say, hey, here's the cash flow. So yes, people might value that cash flow up and down as interest rates change, but like there's still some cash flow that we can point to, right? And the analogy I use, imagine a suitcase with a bunch of money in it. Let's say it had $50,000 in the suitcase, right? If we know there's $50,000 in there, in theory, there's no way like the price of the suitcase should drop below $50,000, right? Like it would be crazy if people were auctioning a suitcase, right? So it's just it's kind of like that. And I think about that example, and I think with stuff like non-income producing assets, we just don't know what's inside, basically.
Speaking about income producing assets, which is your view on dividend income fallacy? Because there are plenty of investors who think that safe withdrawal rate doesn't matter because you can simply pick some stocks paying you dividends and you are safe.
Yeah, so I think the whole dividend thing, and historically owning dividend stocks actually worked and it actually outperformed overall markets. That was at least I don't know through what time period exactly, but I remember reading stuff from like Tweedy Brown and a bunch of other investment firms that showed like, yes, owning high dividend paying stocks was actually a profitable strategy. The problem is corporate finance strategy has changed. And so not everyone pays a dividend anymore, right? There's a lot of companies out there that don't pay dividends, right? Like as far as I know, Berkshire Hathaway has never paid a dividend, right? And because of that, they're always reinvesting their money or they're holding cash and they're saying, hey, we're going to be the stewards of the cash and we know what to do with it, right? And they can build a lot of wealth that way. So if the money is in the right hands at those companies and you have really good capital allocators, they're probably going to do a better job than you. And doesn't mean they always will, but that's just the case where like, dividends aren't everything. I'm not saying they're nothing. So I'm not discounting dividends, but I don't think it's like, oh, dividends paying stocks are going to do better. If you look at like some of those dividend indices and compare it to the S&P 500, you'll see that like most of them have not outperformed the overall market when you include total return, right? And so it goes to show that like just because something's paying you a dividend, yes, there's that psychological crutch of I get this check every month, but at the end of the day, like the S&P 500, you're not seeing the check, the price is just going up more and it's in your balance. You're just not seeing that. You're not seeing a separate payment. And I think that's where the confusion starts to happen. So that's the only thing I would say. I'm not against it. And if you love the idea of, oh my gosh, I just need to buy these 10 dividend stocks and I get this check every quarter and I love it, that's great. I have nothing against that, but just keep in mind that may not necessarily, maximize your wealth on when it comes to equity risk.
As you said, the dividends matter, at least psychologically. They are like, some buffer assets. I think Wade Pfau said that he made some research and 1/3 of people do not resonate actually, or 2/3 do not resonate with this probability-based approach. So they prefer safety first principle.
Yeah. And I think dividend stocks, the other thing too, which I think is a fair point, for example, during the Great Depression, stock prices dropped by about 90% at the bottom, right? So very bad. I mean, especially in the last year, I think from 31 to 32, I think they dropped like 60%. And they were already down like quite a bit at that point. So they dropped 90%, but dividends only dropped by 50%. So companies were paying out cash and those cash flows got cut in half while the prices got cut, got 1/10, right? So $100 became $10, but $100 in dividend income only became $50. So that goes to show that like there is something there. Like if you're living off the income of dividends, your principal may drop a lot, but the dividends don't drop as much. And because of that, there is a good point to be made of, okay, well, if I am living off the income from this, I know with higher certainty that the dividend paying stocks are likely to keep paying. And even if they have to cut dividends, they won't cut as badly as people are likely to cut prices. So I think that is actually a better argument if I'm going to defend the dividend people. And I think that data point right there illustrates it, right? Because companies want to keep paying dividends to make their shareholders happy. So
maybe like Gazprom today, right? Because the stock is worth zero, but at least, I don't know, from what I've noticed, because there is a special committee valuing stocks right now, not a free market anymore. But maybe it still offers dividends. I don't know.
Yeah, we don't know. So,
which do you consider being the hidden costs of becoming wealthy and successful in life?
I don't know this personally. I only know this from looking at and reading a lot of stories about this. I think it can be very alienating if you get too wealthy. And I'm not saying, oh, it's like, oh, first call this first world problems. Oh no, what a bad problem to have, right? People joke about that. But I think there is something to extreme wealth and extreme fame. And those are different, but they're similar in a lot of ways in that you don't know who to trust, right? Like, let's say I was a multi-billionaire. Let's say I was worth $30 billion. It was publicly known. If it's not publicly known, that's different. But let's say it was publicly known. Every date I go on, I'll never know if that person actually likes me for me or they like my wealth, right? So like that's already one interaction, right? If someone reaches out to me, like, do they actually like me or do they just want to get closer to me and my money and want me to pay for them and take that? You don't know, right? So every part of your life gets tainted once you start having a lot of public wealth and you're known for having wealth. If you're not known for having wealth, that's different, right? So if you have a lot of wealth and people don't know about it or, it's very kind of kept, hidden, then it's not a big deal. But I think the hidden costs are that it's tougher to make friends, like legitimate friendships, legitimate relationships. It just affects your social life in a bigger way than people would imagine. And so I think it needs to be public. That's what I think that what you're getting at with the question. And so because of that, that's kind of one of the downsides. It could be alienating. And so, people, we're a very social species, and to feel alienated because of something that you did well, it's kind of funny, right? Like, think about it. You were very successful. You got paid a lot of money for something, or you sold a company, and now people are treating you differently. And because of that, like, you don't know who's being legit with you. And that's kind of a tough thing to go through.
Mr. Nick Maggiuli, I am a believer in the idea of frugality as being the core idea of reaching financial independence, because no matter how much you earn, if you spend too much, you are ruining your finances. However, many people, particularly in Romania, don't have the luck to be able to cut from their spending because they don't earn much. More than 80% of employees earn less than the average salary because of the huge polarity between the rich and the poor. How can people get out of the poverty trap and start building wealth since they are already living frugally?
Yeah, if they're already living frugally, right? So it's like you think about how to save money, like savings rate. It's your income minus your spending. And if your spending can't go down because you said you're already living pretty frugally, the only option you have is to increase your income, right? It's the only way out. Now, of course, what you just said, a lot of people are earning below the average line due to income inequality, things like that. And if there's not a lot of opportunities to earn for some reason or another, like, a lot of times you have to like move around and maybe find other opportunities in different ways. The internet is out there. I mean, so even if you're trapped within a geographical location, there's no excuse, at least in the digital world. In the physical world, yes, you're like, I can't earn money out there. There's nothing I can do. I don't have the skills to do some of these types of jobs. That's a fair point. But on the internet, like, you can earn money in a lot of different ways. Now, I'm not saying that's going to be easy. You can't just turn that on. It takes a long time to kind of do that. But if you can find ways to, I don't know, I write on the internet, for example, but you could create video content. You can do all sorts of stuff and find ways to kind of monetize that in the long run. I think that's really the key. And so for some people, that might be what they have to do. And I'm not saying it's easy, once again, but I think that's the way out, is like finding ways to increase your income. And if that means you can't do it locally, do it on the internet, because there's a lot of money to be made on the internet. And I know, because 3 years ago, over the first 3 years of the blog, I didn't make any money. Then I started making money, and now it's a nice little side hustle, right? So it's one of those things where it can build. It takes a long time, but once you get it going, you'll be surprised at like, wow, that people are willing to pay for that. Okay, cool. Like, that type of stuff happens. So just keep, you have to keep the faith and keep, building at something. And you need some proof of concept, though. Don't just keep spending endless hours doing something if you're getting no reaction, no response, no, hey, this is a good, like, if you're getting absolutely nothing, then it's probably a good signal that you should change it up and try something different. But if you're getting some response and it's just very slow to grow, don't give up yet. I think that's the difference, right? It's like, are you getting slow growth or are you just getting nothing, right? And slow growth's okay, but nothing is bad. So keep that in mind.
That's right. By the way, you mentioned that even with high equality of opportunities, there is still high inequality of income in the United States. Which do you consider are the best tools to reduce extreme levels of inequality?
Taxation, the tax system, probably, if I had to guess. I mean, don't get me wrong, if you give everyone the same opportunity, here's my theory. I've heard this idea before, but I agree with it in some ways. Let's say we took all the wealth in the world and we just equally distributed it. And we literally had some mechanism to confiscate all the wealth, and we gave every person on the planet the same amount of wealth starting tomorrow, right? Within a few generations, there would be inequalities again, just because differences in skill levels, tons of differences, right?
Yes.
It depends on what the economy values, right? But given a certain set of value, a certain value system, there's going to be inequalities that will emerge, right? Like, let's say tomorrow, everyone just started really valuing people that, I don't know, knew French or knew Italian, right? Anyone who knew that, let's say people are willing to pay extra, like 10 times more to learn that language for some reason. I don't know. I have no clue. Let's say an alien race comes and if you speak French, they don't kidnap you or something. I don't know. I'm coming up with some crazy idea, but let's say that's true. Now, tomorrow, all French speakers now have a 10x premium on this skill, like of speaking French. Okay, immediately, all this money is going to start flowing to them because that's what the economy values, right? Of course, this is a very extreme, crazy scenario, but it gets at, like, because we have certain values and value certain things in society, certain people with either those skill sets or something related to those values are going to get a disproportionate share of income and wealth over the long run. And you're going to see that happen. Now, I, of course, agree with a progressive taxation and taxation system, because I think with that, if we let that just run unabated, people can keep wealth forever, right? It's very possible. But the whole way, the whole premise of taxation is so that we kind of reduce that a bit and it makes society better, and, we live in a better place and all sorts of stuff because of that. So I'm definitely a big fan of progressive taxation. I think that's the way to do it. But I think there's always going to be some inequality. The question is, how much should we allow and how much is okay? Really, that's the bigger question.
And if you think about compound interest, the poorer you are, you basically have almost no chance to, remove this gap, or
To
at
catch
least
up, yeah.
make it smaller.
Yeah, exactly. So I think the analogy I like to use, if you've ever been driving in a car, right, and someone passes you, right? Let's say if they're going even 1 mile, if you're going, 60 kilometers an hour and they're going 61, if you look at them, they're going a little bit faster than you, but they slowly pass you, right? Then imagine someone going 62, 65, 70, 100 kilometers an hour. They'll fly right by you, right? So if you start way ahead of someone, but they're going faster than you, they will eventually catch up. It may take a very long time, but they'll catch up. And the issue is, if the rate of change is too slow between those two, or it's like stagnant, then they'll never catch up. And you're right. And so that's, I think, the premise of what you're getting at.
How valuable are your returns on investments if you live pretty frugal and become rich at the age of 50, but you don't have enough time to enjoy your life, since time is the most valuable commodity? Don't you think wealth accumulation might be a trap for not spending your life?
It can be. And there's a great book out there called Die with Zero by Bill Perkins. And I recommend people read it because it does get at this question of, like, okay, I'm going to save for 40 years, have this retirement just so I can live 10 to 15 good years, or maybe 20 years at the end, right? I know we plan for 30-year retirements, but not many people are living to 95, if we're being honest. Most people are, dying in their 70s and 80s, at least in the US, right? So, of course, some live into their 90s. It's rare, but it's one of those things where, like, how much enjoyment you're going to get out of life at that age, unless you can, most people aren't, their mental faculties aren't there, among other things. So it's very interesting. But yeah, I would say, try to enjoy your life a little bit more now. Find a balance, right? Don't say, hey, YOLO and, do everything today and carpe diem and just spend all your money today, but don't also, save everything. You got to find a balance, right? You got to don't move everything to the end. Don't have everything now. Just kind of try and balance that over time. That's, I think, the key.
We have this dichotomy between you only live once and delay gratification. And is a famous quote saying, travel, your money will return, your time won't. How can we achieve the right balance between these two approaches?
I don't know. It's a great question. Every person's different, right? Every person's going to have a different, like, for example, if I was spending much more, I think I would feel uncomfortable because I feel like I'm overspending in some way. So that's one thing. I already have a high level of spending. I live in New York City. It's very expensive here now. Like, cocktails are now $20 to $25, like, regularly, when they used to be, 15 to 20. Now it's like the prices are going up. Now glasses of wine are regularly, I'm seeing $30 glasses of wine, which seems crazy to me. I know in Spain you can get them for like 3-4 euros. So it's like, how is this make any sense, right? So it's a little crazy, but that's what's happening. So I'm seeing, inflation is happening here, especially in the higher end of the market. And so, how do you find that balance? I don't know. It's a great question. I don't have a perfect answer for it. I think it's just find what you value and just really be okay spending more money there. And the things you don't value, cut mercilessly. Like, I am not a person that's going to go spend a ton of money on clothes, right? Unless there's some sort of like, hey, it's going to last much longer. Besides that, I don't spend a ton on clothes. I don't have a car. I own no furniture. This is all furnished. I mean, these are my book copies or different editions of the book, but like I don't own any of this furniture. So I don't own a lot of stuff. I just own a lot of financial securities, and I like going out to restaurants. That's like my two big things, you know?
Amazing answer.
Mm-hmm.
Even when you stop from working and let's say are coasting to retirement, it still takes plenty of time for your investments to compound. In this respect, how crazy crypto investors are who have the goal to either become rich or die trading. If they succeed, do you consider it luck or skill?
I guess it depends the time
plenty
frame.
of
Yeah.
millionaires from crypto in Romania.
Yeah. So I think right now, well, here's a question I have for you then. Maybe you can talk about this. We can get a little discussion. But I guess the answer is, okay, they were crypto millionaires. With everything going on right now, you just heard about the FTX bankruptcy. You heard about a lot of these events. Like the question is, are they still crypto millionaires, right? And that's the question, right? It's like, when you take high risk, when you start doing a high risk strategy, you can get very wealthy. You can definitely, succeed very well. But if you keep doing that strategy, you can lose it all as well. I know so many people that were once rich and they lost everything because of, they started trading in Luna and they started trading all these other altcoins, and all these things are down so bad, people, and they owe taxes on it now. So there's a lot of people that have just been, wiped out who used to be millionaires. I know one guy who was a millionaire, someone else who was almost a millionaire, and someone else who was actually a multimillionaire and actually moved to Puerto Rico from the US to not deal with taxes and stuff. And now because crypto's down so bad, like he's like in deep, like he's in a hole because he owes taxes, yet he doesn't have, if he sold all his coins, he doesn't have the money for it, right? Because he's day trading. When you're day trading, you're trading in and out and you're accumulating gains, right? So you have to pay taxes on that. But if all your underlying collapses, you're kind of screwed. So I've just seen all sorts of stuff. So that's my question to you is like, are those people still millionaires? And that's the thing you have to find out.
Some of them still are, but from what I've noticed, they don't have a proper risk management. I mean, they go all in with this asset class. They get lucky and maybe then start, I don't know, withdrawing some money, but they don't have, let's say, like a risk-based approach. They only think about setting a price target. Let's say Bitcoin will go to 100K and then I will start selling.
Well, it didn't go to 100K, so they're still holding then. So that's not a great look. But yeah, I mean, of course, there's some luck involved. Of course, there's luck. I mean, I think the skill is holding for a long period. If you've owned Bitcoin when it was, below, let's say $100 a coin, and you're still holding it, I think there is some skill in that and some being able to deal with these 80-90% drawdowns and say, I believe in this asset class. I think there is something there. Of course, yes, the fact that it went up a ton is luck as well. So it's a mix of both, I think. It really depends on the person and how they did it. If they just got into crypto in like end of 2020 and then they, made all this money, that's very different than if they've been in there for, 5, 7, 10 years doing this stuff.
It's pretty frustrating to see this kind of crazy returns for an asset class which has no internal rate of return.
I agree, but that's why non-income producing assets can do that. I mean, where's the internal rate of return on gold? Yet somehow it's valued. It's all the gold in the world is valued at something. So it's the same thing. Same with art. I mean, you can say you put a private value on art, but how do we sell it to other people? It's a great question. But all these things have returns. So
you mentioned on your blog regarding Hendrik Bessembinder, who published a paper showing how 4% of all stocks listed accounted for the entire excess return over the treasury bill since 1926. What do you think about the skewness risk of investing in individual stocks, and how optimistic are you about the asset class as a whole?
I'm very optimistic about stocks as a whole. I mean, just generally, because I believe in long-term economic growth, human prosperity, etc. In terms of the skewness, that's why I own index funds, because I don't think I can pick the winners. I think it's tough to pick the winners. And even if I can pick the winners in one market regime, doesn't mean I'm going to pick them in the next market regime. So I think because of that, you kind of have to own the whole basket. And by owning the whole basket, you own that 4%. And that 4% is what builds your wealth, right? Because in theory, otherwise you would just own treasury bills and then you would try and pick those 4%, obviously. But it's very difficult to do. So because of that, I say own the whole basket. Buy index funds, be broadly diversified, and don't worry about it. Spend your time doing something else, right? Because at the end of the day, it's not just the it's not just the financial return you have to worry about. You have to also worry about the return on your time. So how much time are you spending researching other stocks, doing all that stuff when you could be earning more income, right? Because that income could exceed any sort of alpha you produce, or you remember you could still have negative alpha, right? So let's ignore that. Let's just say you can actually produce alpha. There's no guarantee that the alpha you produce is going to outweigh the actual income you could have made if you had just, been working a second job or something, for example.
As John Bogle says, don't seek for the needle in the haystack, just buy the haystack.
Yeah, exactly. Yes, and Bogle is the true visionary. One of the few people in finance who I think was just to the core, just had the right message, was doing the right thing, wasn't trying to screw people over, wasn't a snake oil salesman. Just one of the few people that's really like that. So huge admirer of Bogle.
That's right. Now, as an example, for those who invest in individual stocks, imagine you have bought two individual stocks, Alibaba and Facebook, which are both down 25% and 50% respectively. Assuming you're not Warren Buffett to hold them forever, when would you decide to sell to avoid that disposition effect of riding losers too much and selling winners too early? And would you take into account, valuation, or maybe have a specific price target or a specific time horizon until you start trimming your position? I'm just thinking about how would you think about risk and reward here.
Yeah, so I generally don't own individual stocks. Anytime I bought them, I've actually only owned 4 individual stocks in my life. 2 of them I ended up like net flat. But this was many years ago. And then I got caught up a little bit in the tech stuff. I only put 1% of my net worth. So it was a very, very small amount of money. But I had 2 individual tech stocks last year, and one was down 75%. The other one was down 90%. And this is the one that was down 77% actually. At point was up over 120%, which is crazy, right? Like I put in my initial investment was up 120%. I didn't sell any. I said I'm just going to hold it and wait. I didn't want to do the disposition effect selling on my winners, right? So I just held it. But now it's a loser. I didn't sell it quickly enough. So what's the answer? Like there's no great answer, because you might sell something that's down. Oh, if I say once it's down 20%, get out. Like you could do that. The problem is like what happens if it recovers? Like what happens if you sell Amazon and it goes up to become the next big? I don't know. I don't know what the answer is. Some people do this thing where they say, hey, once I've, covered my cost basis, like for example, if something doubles, maybe you sell half of it, and then you just let the rest ride. Yeah. So at least you have no loss of cost basis, right? Like you at least get your cost basis back and you're just riding your gain. So if that goes to zero, you just lost the profit and you just say, hey, I made nothing on that money, basically. I generally don't recommend that. Just be diversified. Stop wasting time on that stuff. It's really tough. And I think if anything, like the last year has shown how tough it is. And so there's so many people that are down very bad right now because of that.
If let's say you have a huge drawdown and then you recover and you are again break even, would it make sense to begin again lowering your exposure then? Or waiting more until it goes up?
What if it doesn't go up? That's the problem, right? Like I own 2 stocks where they just kept going down. And they kept going down. Even now they're still more down than after I sold them. So I sold them like a couple weeks ago and they're going down more, right? So it's like, assets that tend to trend down. I mean, this is why momentum's a thing. Generally, assets that are trending down keep trending down. Assets that are trending up keep trending up, right? I mean, that's not true forever. Of course, the market's been going down too, so there's a general effect. But if the market turns around, starts coming back, maybe they will start to come back. But who knows when that's going to happen? So I've learned my lesson. Never again with individual stocks. I don't care not doing it. The only thing I might do is small private investments in like companies of friends or people I know, but just they'll keep them very small. As I said, like less than 1% of my net worth and these like little individual investments, things like that. Outside of that, no more individual stocks.
Great. While CAPE is not a good indicator for market timing, it has proven to be quite reliable for forecasting expecting returns, at least in markets with cyclicality, like, emerging markets. What is your view on implementing a CAPE-based investment strategy?
I think it's tough because things change over time. I mean, CAPE you should look at CAPE and also look at relative to the interest rate, right? Because when interest rates start to go, it's always relative. Like, what else could I do with my money, right? So people are like, oh my God, CAPE's so high right now. And like, yes, like in theory, if interest rates go down and you're not making as much on your bonds, people are going to probably try and chase yield elsewhere and they're going to bid up stock prices, right? So to the point where, P over E, price over earnings, right? You can think of that as like if you inverse it, earnings over price, it's the earnings yield. So as P over E goes up, earnings yield goes down. And so an earnings yield is down because bond yields are down, therefore earnings yield would expect to go down. But now that bonds are coming back up, you would think the opposite would happen. So that's why, stock prices are being discounted because interest rates are rising, right? So it makes a lot of sense, like when you think about it, and over a 10-year period, it's actually decently predictive of how stocks return. But I don't think these timing strategies work because people change over time and it's tough to know what's going to happen next. And, there's just periods where people don't want to own stocks and they beat them down even when it doesn't make sense. Like the early 80s was like probably the best time in US history to buy stocks because the CAPE was so low and people, why? Because we just went through a really rough period. We went from like the late 60s all through the entire 70s, stocks were dead. There was the death of equities. There's a famous US magazine cover. It said the death of equities, right? People had given up on stocks by 1980. Interest rates were through the roof, right? Like interest rates have never been, I think, high, maybe not never higher in the country, but at least in the modern history, never been higher. People had given up on stocks altogether. But guess what? That started the next greatest 20 years in arguably US stock history, right? So you gotta realize like that these types of things happen, and so it's once they're beaten down, that's maybe the time when it's best to buy. So who knows?
If someone, let's say, heavily tilts his portfolio towards non-US stocks, which are expensive both in terms of valuation and also currency, let's say from emerging markets, and stays invested for the very long term, should they expect to earn higher expected return or buy higher volatility, or not, due to, let's say, idiosyncratic risks? Which do you consider being the main disadvantages of pursuing this strategy right now?
Of just owning, like you're saying, emerging market stocks generally, or which market were we looking at?
Let's say emerging markets and also developed markets, non-US, which are cheaper right now.
Okay, I mean, you can do stuff like that. I mean, once again, I think a lot of this stuff we're talking on the margin with a lot of these strategies. Like, should we do this? Should we do that? There's all these like what ifs. And I think the most important thing, if we're being honest, is like, what is the world return doing? What's beta, right? What's the market going to do, right? And so you're going to make money when, markets are going up, like generally, right? And that's going to be true in the US. That's going to be true developing markets, emerging. I think just owning a basket of global stocks is the solution, because when US has a bad decade or something, or a bad 5-year period, and don't get me wrong, the developed world can have that too. They can be correlated, but a lot of times they're not, right? Like from 2000 to 2010, US stocks did horribly, but emerging markets did very well. Now from 2010 to now, or at least 2020, US stocks did incredibly well, but emerging markets didn't, right? So I'm not saying that keeps repeating, it's going to keep happening, but in terms of like trying to look at volatility, in terms of trying to look at all these other measures, we can sit here and beat these measures into the ground. And I just don't believe in a lot of these strategies because I think it's really tough to do consistently and not get emotional and try to have rules-based things. And so just like own a global asset and just own them as a diversified asset class and just don't worry about it as much. That's my takeaway. So of course, not everyone has exposure to all these asset classes. Some people can't buy US stocks out there, right? So I know that there's not the exposure, which is unfortunate. Then you got to get exposure in some way or another. Find ways to get exposure to those things. Find assets that might be correlated with US stocks if you can't own US stocks directly.
We usually think about money in absolute terms, but we should also take into account the time and effort put in place to acquire them. Some say that money is infinite because it's printed by central banks, while most individuals are struggling to satisfy their daily needs given the lack of money. How valuable do you think passive income is compared to active revenue streams? And how should we handle price swings when no longer having active income?
Yeah, so I think the thing about passive income, like, yes, that's helpful. I mean, I see what you mean in terms of like, oh, passive income, like once I'm retired and I'm just living off my financial capital, like that makes a lot of sense. I think you're going to have to de-risk. That's the solution. That's how most retirees do. If you're 20 years old and you're an investor, you should be taking a lot more risks than if you're 65 years old and have no income, right? Because there's fewer levers you have, right? You don't have the time lever, or as much of a time lever when you're 65. You don't have the ability to earn income and offset declines in your portfolio like you do when you're 20, right? There's all these levers you're losing. So you lose your labor income lever, you lose the time lever, you lose a bunch of things, right? And because of that, you have to get more defensive. So I think the key is to get more defensive and take less risk over time. And generally, that means owning more bonds. Of course, you saw bonds are down very badly this year, but now they're at a place where with higher yields, they actually can have a decent place in the portfolio. So we'll have to wait and see.
There is a famous Boglehead saying, stocks let us eat well while bonds let us sleep well. Right now, bonds seem to eat our returns as well due to rising inflation. I remember they were called certificates of confiscation in late 80s or 70s. Which do you consider being the right mix for a young investor in today's market? Also, would you use riskless assets to increase your equity allocation during market downturns or prefer static asset allocation? And what do you think about this liquidity issue? Because right now, if you sell bonds, you also sell at a loss. So you have to think about opportunity cost.
Yeah. So there's a lot of questions there. Let me first address the question about what's the right mix. I don't know the right mix. Every person is going to be different. But a young investor, I'll just tell you what I did. I'm not going to say this is right, but I was 85% risk assets, 15% U.S. bonds, right? For most of my career. As of right now, I was at 5% U.S. bonds. I'm now at 0, but I'm probably going to buy some bonds very soon because rates are still going up. And so if I expect the Fed to increase rates, in next month by another 50 bips or something, then they do that, then I might buy a 6-month treasury, or I might buy a T-bill or something, or I might buy something like that, or I'm trying to actually buy some real estate, physical real estate finally, not just REITs. And so I might take my cash and park it there for the time being. But right now I basically am just holding cash before I buy some bonds because I'm thinking about getting into real estate. But that's a personal thing I'm doing, right? So having a small bond allocation, I think right now it actually makes more sense to increase bond allocations relative to history when they were paying nothing. Like there was not as much of a reason to own as much bonds, right? So I think that's changing now with rates. So that's the first thing I'm going to say there. In terms of, but you're selling bonds right now, you're selling at a loss. Like, yes, but like that's what happens. I mean, when you're in a low rate environment, low inflation environment, right? And then all of a sudden rates increase rapidly and inflation's increasing. That's literally like the perfect storm for bonds, right? Because when rates go up, and especially if they go up quickly, your bond looks relative to the market looks pretty, crappy. No one wants to own that bond. It's a terrible bond. So no one owns it. So that's where the price goes down, right? That's one thing. And then with inflation going up, that bond's paying you money that can't move with inflation. So that screws you too. So there's a host of reasons why bonds are down badly. On real terms, right? Not just nominal terms. So it makes sense what's happening. But now that yields are up again, maybe there's a chance that they'll actually be worth something. And we just don't know. We're going to have to wait and see. So
do you prefer dynamic asset allocation or static?
How do you define dynamic? I guess I would say probably dynamic, but I want to get your definition first.
Maybe not. I don't know. Thinking about a glide path or rising equity glide path, like buying more when equities go down.
Yeah. So I talk about this in the book. It's the chapter on, I think, taxes. I believe to talk about this a little bit, or maybe it's the one. Oh no, it's on selling. I apologize. The one on when should you sell? In that chapter, I'm talking about rebalancing, and I talk about what I call an accumulation rebalance, which is basically instead of, let's say you had a 60-40, 60% stock, 40% US bond portfolio, and it became a 50-50 because let's say US stocks dropped a lot, right? So now it's 50-50. Instead of selling the bonds to buy more stocks to get back to 60-40, what you could do is, if you're an accumulator, you're saving money. You just, instead of putting money into bonds, you just start putting a lot more money into stocks to get it back to 60-40. So it's like, I call it an accumulation rebalance, because instead of selling anything in it, there's no tax consequences. You can just buy the underweight asset as a way to get back to your core allocation. And that's what I try to do, right? So I'm always trying to add money over time. And as I'm adding money, I'm just kind of re-triggering the weights. So I usually do that at least once a year. Sometimes I'm doing it more often than that. But yeah, that's what I'd recommend, is something like that. And I just, go from there.
Speaking about rebalancing, which is your view on rebalanced versus unrebalanced portfolios? I've seen some research from Michael Kitzes stating that unrebalanced portfolios might overperform due to positive momentum, but they are also riskier than rebalanced portfolios due to increased drawdown risk.
That's completely true. And I think the reason why, and when most people talk about rebalancing, they're talking about stocks and bonds, US stocks, US bonds. I know it's very boring, but this is the bulk of the assets, in the US investable assets are going to be in obviously real estate and then stocks and bonds right after that. So because of that, if we expect bonds to earn you less, right, have lower returns than stocks, and if we expect, just over a long period of time that these asset classes will convert to their average return. That means over a long period of time, the stocks are going to grow to more than the bonds. So if you never rebalance, that's the most profitable thing you can do, because on average, over a very long period of time, the stocks are going to grow more, right? So it's like, why would I take money from the stocks and from the high growth thing and put them into the low growth thing? It makes no sense, right? According to, if you're just trying to maximize every dollar, you would never rebalance. And in fact, you would never even own bonds to begin with. Why would you even own bonds, right? The whole issue, the reason you own bonds is the risk reduction, right? That's the whole reason, right? If I said, okay, I just want to maximize every dollar I have, how much bond should I own? And let's assume you could just weather any drawdown, I would say zero, right? But if you can't weather drawdowns, if you don't know about how you're going to act behaviorally, then you need those bonds as a way to maximize long-term returns, because you might sell in a panic, right? That's the reason why bonds can actually maximize behavior-adjusted returns, right? That's the way of looking at it. Call it behavior-adjusted returns, which are hard to measure because we can't know how you would have behaved, not having bonds or having bonds, right? We have to guess, right? And so that's the idea. And so even though on total returns, it's better to have no bonds and just have higher growth assets, behavior adjusted returns might be higher by owning some bonds. And so that's the question is, what is the balance that maximizes your, what I would call behavior adjusted returns?
You also mentioned in one of your blog posts that by saving and investing, you are rebuilding yourself as a financial asset equivalent that can provide you with income when you no longer work. How much do you consider being enough to stop working and start spending your life?
This is a great question. I think you got to take one of the rules out there is 4% rule, 25 times your annual spending. So if you spend $100,000 a year, you would need $2.5 million, right? Or whatever, 100,000 units of currency, you need 2.5 million of those units. That's one way to look at it, and that probably could work. I still think the 4% rule is probably a decent rule of thumb. And the only reason I like it is because it's so quick. You can just do that math in your head. Like 25 times X, that's easy. And you can take a calculator to do it if you need to, right? But you can do that math in your head, and it takes all these complicated formulas and thinking about how long I'm going to live and all that, and it just says, hey, just multiply your annual spending by 25. Once you hit that number, you're good, right? So that's an easy way to do it. But for some people, that's so out of reach. Like if you have $100,000 and you're like, okay, well, I spend, 50 grand a year. Okay, I need 1.25 million. That's a million. That's over $1 million away, right, from where I am now. And so that can seem like a very far goal. The idea, though, is to constantly invest over a long period of time and build wealth.
Famous philosopher Epictetus has said that man is not worried by real problems so much as by his imagined anxieties about real problems. In this respect, rich people might still worry about how to manage their wealth, becoming anxious about losing their financial status. How can we stop worrying about money once we have enough and focus on enjoying life instead? What should we do with our free time so that to keep having a purpose and meaning in life?
Yeah, so those are great questions. I mean, what can we do to not worry about finance? That's a $1 million question, maybe $1 billion question, right? Like, how do you get people to stop worrying? I don't know the answer to that. I really don't. I can try and throw out different things that might work. Try and find the things that you value outside of just money. And how do you know when you have enough? That's a great question. That's a really, really tough question. How do you know when you have enough? Because the problem is risk. And I think most people oversave because they're worried about risk. They're worried about getting some, life-altering rare disease that requires this incredible expensive treatment that their insurance doesn't cover. And so now they're out of pocket. At least in the US is a very real thing. And in places in Europe, the medical care is covered. But in the US, this is not necessarily true. So because of that, it's oh, I thought having $3 million was enough, and I just blew through $1 million in a year paying for my medical care, right? And that's an example of that type of stuff happens, right? And so it's rare. It's incredibly rare, though. So it's how do you tell people you're going to be fine, and then to find out they get hit with this crazy thing and then they're not fine? I don't know. I don't know the answer to that. I think you gotta just have to hope that you don't get something really, really, really rare like that happen to you. And you hope you're going to be okay. The other thing to do is you're right, just find purpose and meaning elsewhere, right? Outside of just your finance, because you can get caught up in that very easily. So I think that's, life's much more than money. Money obviously matters. It's a context that can allow you to do certain things and gives you freedom and the ability to do and, choose what you can do with your time, which is important. But if you don't know what you're going to do with that time, what good is it, right? I think that's the more important question.
When it comes to FIRE movement, almost everybody considers that early retirement success is based on retiring rather sooner than later. However, I remember that you mentioned in one of your blog posts, don't win the game too early, that people should postpone early retirement as long as they can to live a happy and meaningful life. Could you perhaps develop this idea?
Yeah, so I think the main idea there is like there's all these people that think, okay, I wish I could just have, $1 million and go chill on the beach and wouldn't have to work ever again. But don't get me wrong, that could be fun for a little while, but I think most people will find that that feels very empty after some time. And I only say this not from personal experience. I can probably tell you that just when I go on vacations that last 2 weeks, by the end of the second week, I want to get back to work. I want to get back to doing something productive. I feel like I need to do that versus like, oh my gosh, like I want to just take another 2 weeks off. Like I don't want to do that. I feel like I need to do something and build towards something, right? And so I think anecdotally, what I've seen from a lot of people who got rich from selling companies or being an early employee somewhere, they want to go back to building things, right? And I think the best example of this, Mark Zuckerberg, when he was building Facebook, Yahoo offered him $1 billion for it, and he said, "Why would I sell?" He's like, "What would I do? I'm going to take that $1 billion and then just want to build another social media company. So it makes no sense. Why would I stop doing what I'm already doing, what I want to be doing, just for money?" And it's silly. So I think that's the right solution, is realizing, okay, what do you actually want to do and what do you care about, and just focus on that. And that's going to be more fulfilling than like just the money part of it.
What about the other risk? How can you alleviate the alternative risk of having too much money in retirement? And let's say if you don't want to leave a big quest.
Having too much money in retirement. I mean, I guess the key, this gets back to die with zero, gets back to a lot of this discussion, things we were talking about earlier. I don't know the solution to that. You got to just be like, hey, I probably saved too much. Okay, what can I do to spend more, and try and force yourself to spend more money or give it away or something. It's a problem that most people don't have, but it's one that you should consider and think about how can I do this? Maybe I can give back in a way that's really meaningful.
In a world of increased correlations across asset classes, are there still benefits of diversification?
Yes, I think in the good times, diversification still has a high benefit because assets don't always tend to follow each other. It's just when everything is crashing, liquidity gets crunched, people are selling everywhere, right? So that's why the correlations, quote, go to one or tend to go to one during these crashes, right? That's why, real estate or REITs, US stocks, US bonds, all these things can start crashing together when everyone's trying to exit to move to cash for some reason. So that's an example of what can happen. So, yeah, I would say diversification's definitely there for the good times. That's when it matters. In the bad times, it's not going to save you, at least in terms of diversified risk assets. If you have some like lower risk assets, I think those generally can be helpful, even during crashes. But I think we're talking about risk assets and those moving toward one during crashes.
Do you think factor-based investing can enhance returns for retail investors?
It definitely can. I think it's just a question of which factors, how do you pick the factors? There's so much, as they say, the phrase is the devil's in the details, because how you pick factors, which factors, how long have they worked for, which time period, you can tell a story about almost every factor. Like, momentum's a great factor, right? But does it always work? Does it work in every time period? Not necessarily, right? Does value work in every time period? Not necessarily, right? These are the two most important factors of history, yet they're very difficult. It's difficult to do that because everyone's going to benchmark to the market, right? That's why I say just own an index fund, like own, the market, because you're getting beta. And so everyone benchmarks to that. So when you're doing better than that, you feel great. But when you're doing worse, you feel terrible. And value is a great example of that. Value, I think, has outperformed mostly this year. But in the last couple of years before that, value was doing terribly, very terribly. And you would have felt terrible being in there. So that's why I generally am like, just own beta, own the market.
Do you think individuals should split their expenses into basic and discretionary ones, like Wade Pfau recommends, and take into account some supplemental income in retirement from a side hustle to cover discretionary needs, rather than save and invest more to grow their nest egg once they have some base level of financial security?
Yeah, I definitely think that people should have some base level of like emergency savings, things like that, and then start investing. I think that's far more important because personal risk is the thing that could really, take you out. And I don't want to see you have a huge portfolio and then nothing saved on the outside. And then you have to end up selling that. You have to think about it's the chain reaction of events that happens. It's like, okay, I lost my job and now I have to pay for expenses, but I didn't have any emergency savings. Okay, that's one bad thing. Now, not only you lost your job, you probably lost your job, assuming it wasn't like some random reason. Maybe you got laid off because the economy is not doing great. Well, now the economy is not doing great, so now your assets have declined. So now you have to sell assets have declined, right? So now you're selling into a bad market, right, which is not good, right? You're selling at a loss, which is not good. And then you're taking that money and using it for emergency. If you just had that money set aside from the beginning, you wouldn't have to worry about that, right? That's kind of the takeaway.
How do you invest your own money, and what is your view of traditional career paths?
So how I invest my own money, as I said, broad-based index funds. I own global. I have like half my stuff in US, half in split between developed and emerging stocks. I own some REITs. I used to own some bonds. Well, I don't really own any now, but I will get into some eventually. That's like about 90% of my assets. The other 10% is split up in crypto, art, and some small businesses, private businesses, a couple of them, but it's very small. And that's basically the rest of it, right? And so that's how I got to 100%. So that's how I invest. And in terms of, wait, I'm sorry, what was the second question again?
What is your view about traditional career paths?
Yeah, I think there's nothing wrong with traditional career paths. I think it's like everyone's like, oh, you have to have a side hustle, you have to do this or that, or you have to own your own business. I don't think that's necessary. Don't get me wrong. You can obviously make more money with this. You can make extra money with the side hustle. You can, if you're trying to build a business and it does really well, you're going to get far richer if you have your own business and you can own all the equity versus, working in a company. It really depends, obviously, but there's a lot more risk, right? So you have to think about what are you maximizing for? If you're trying to maximize for, just total money and you're like, I want to be a billionaire, then you have to start your own business. I think it's really not possible. It's very rare to like become a billionaire. And you don't own the equity of some sort of stock or of company of some sort.
How do you overcome anxiety and psychological stress during the evil hours of market downturn, such as Black Monday, if you suffer from financial post-traumatic stress disorder?
Yeah, so that's a great question. I don't know how to overcome those, especially if you suffer from that. I think the thing is like, I try to focus on history. As I said, we talked about this earlier, and I think that's the big thing. Is like focus on history, realize that things repeat themselves. This stuff's going to happen, or I think we will see another 15% or 15%, 20% down day at some point in the future. When, I don't know. It's very, I think those types of things are very rare. Actually, it's tough because they're circuit breakers now, so we can't really do that like we used to, because they would stop the market. So I don't know if we could ever get to 20% because they would just shut the market down for the day, I think at 15%. So these are the types of things where circuit breakers are in place to prevent this type of stuff.
Mr. Nick Maggiuli, I am very grateful that I had the chance to discuss with you today. I would like to thank you very much for accepting my invitation to participate as a guest within our investing podcast. It's always a pleasure to read your articles and learn from your investing knowledge. You have an amazing blog of dollars and data. Also, I hope everyone will start reading your book. Just keep buying, which is also amazing. I would like to really congratulate you for the Go Big Then Stop article. I think that was the best from all of them. It was really amazing, and I found the same idea even in Thoreau's book, who was preaching laziness and not striving for money. He said that you don't need much in order to live a happy and meaningful life, but also that if you don't enjoy leisure right now, then second best thing you can do is to work twice as hard as in the present, so that to accelerate your path towards financial freedom. And I liked that article because it was showing that someone who has saved for only 10 years has actually outperformed someone who saved for 30 years but who started later to invest. I think after 10 years was the example.
Yeah, and 10 years, after 10 years, it's half basically. They're roughly the same. So the first 10, if you save for 40 years at a 7% rate of return, the first 10 years, save the same amount of money every year. The first 10 years will equal half the final balance, and the 30 years after that will make up the other half, which is kind of crazy.
And basically, it was showing that compound interest really works if you start earlier to invest, and it can outperform your let's say human capital.
Yes, very true. So I completely agree with that.
Now, famous last words are yours, Nick Maggiuli.
Thank you. Appreciate that. Thank you everyone for listening. Hope you guys like my work. And if you want to reach out to me, feel free. I'm on Twitter, just at Dollars and Data. You can reach out to me there. I'm also on Instagram at Nick Maggiuli. You can find me there. And yeah, if you guys have any questions, feel free to DM me. I try to answer all my DMs. Thank you for your time.
Thank you very much, Nick Maggiuli. Also, thank you everybody for listening. I would like to wish you happy investing for the next decade. And don't forget, just keep buying.
Thank you.
Bye. Bye.
All right.